What it's trying to do is just normalize the profitability of the company so that you can use it as a basis for the valuation. And what I mean by that is you need to strip out one-time or non-recurring expenses so that you as a potential new owner can just say to yourself, what do I think the approximate profitability of this company is going to be going forward?
So M&A, right? Buying companies, understanding, EBITDA, how to arrive at EBITDA, how to do all of these things that are so important to evaluating businesses. Talk about your approach to that and how you help people get clear on the numbers there.
So EBITDA is one of these metrics that's such a hot and cold thing in the world of finance, and a lot of people hate it, and I understand that because the real reason is because EBITDA is not part of GAAP, not part of GAAP accounting, and so what happens is you can start to get a little bit creative. Well, I'll say creative, but people really you get carried away with calculating what is my adjusted EBITDA, and people might think you're overly inflating your earnings or overly inflating your valuation, and that can definitely happen. I've seen that happen. What it's trying to do is just normalize the profitability of the company so that you can use it as a basis for the valuation. And what I mean by that is you need to strip out one-time or non-recurring expenses so that you as a potential new owner can just say to yourself, what do I think the approximate profitability of this company is going to be going forward? And so when I break down EBITDA, I usually like to break it into a couple schedules to keep things clear. And this would normally map what's called a Q of E or a quality of earnings, where you walk through the different EBITDA adjustments as you're modeling. And typically it starts with EBITDA as defined, which is the definition that I think most of us know, which is the earnings before the interest, the taxes, the depreciation, and the amortization. And that's like a baseline EBITDA that we can all agree on. And then from there, it's when we start to get a little bit carried away. It gets into what's called management adjustments, where they can pick one-time things that ideally are not going to occur again and do what's called add them back. So like if they hired a consultant temporarily, that cost is going to be non-recurring. That's something they would add back to their EBITDA. And there's going to be a whole list of things that management wants to add. And as you increase the EBITDA, you potentially increase the valuation. And so that's where some of that friction comes from. And then lastly, there's adjustments on the diligence side. As a private equity firm, if you're going to be acquiring this company, there are all kinds of diligence costs that go into closing, like hiring lawyers and accountants and phase one surveys and whatever it may be. That all gets expensed to the company at close and results in a negative net income. But those are non-recurring costs. And so those are going to come back to EBITDA. And so we're going to build those back in what's called the diligence adjusted schedule. And so I've already talked through three sections. Again, it's non-GAAP. So you can see how people can get carried away when they really start to add all kinds of adjustments that don't necessarily need to be there. And that's the gripe. But again, big picture, we're trying to find normalized profitability so that we say to ourselves, all right, if we buy this company, is it actually going to generate a profit going forward so it can pay the interest that we're going to put on the company and then return the equity that we've invested?